there are some key things that I want to talk about. When they asked us at work, who would like to come and talk for 2 hours about, for financial literacy, we all sat on our hands, no one moved, we all just zipped to their lips. And it wasn't until a bit later on I sort of thought about it, and for me there's a lot of stuff that we're talking to every day with our contractors, and it was just like, yeah, there is a lot there. There's enough content to go through that, points that I'd like to highlight to our contractors to get them all on board, that I think would be relevant and for them to understand and make them stronger in their business, basically. Especially nowadays, because it is a pretty tough environment out there. If you're talking rate negotiations, if you're trying to go for tenders, even just getting finances, getting harder and harder nowadays. Banks want more information. So you need to sort of understand the drivers behind those rates, the drivers behind what the bank's looking for, so you can just make better decisions. And on top of that, the last few years we've seen a massive increase in, everyone knows about the cost of living, but that's filtered right through to contract expenses as well. And I think, a lot of contracts might be 3-year term. Some of those, back in sort of set in 2019, the day rates there are just so blown out of the water. We've had inflation at least 6-7% in the last few years. So those rates are just so far behind, and they move very quickly, and there was a lag in between times. And I think some people got caught out in the lag. They didn't see the numbers changing, and they were very slow to react and sort of work out that they were miles behind. But anyway, I'll talk briefly about my background. I can't imagine many people want to grow up to be accountants. So anyone want to be an accountant when they were at school? Okay, well, you're doing more than me then. I mucked around for a long time paddling, and it wasn't until I met my wife, sort of about 24, that she's like, maybe you should do something slightly different. So I did saw an ad in the paper for at Kajawala Forestry, which had the big processing yards in Murupara and Kawerau, and a couple of bush crews. So I started running around the bush there, mostly just stenciling the ends of logs, to be honest. Occasionally they'd let me sort of get a logger's tape and actually sort of try and make some logs. But I was there when they were run by Fletchers, and at that time my role was supposed to be sort of managing the information flow they had to their log plans and sort of tracking logs, and so my role sort of eventually got made redundant, and they said, you're welcome to stay, but you have to learn to use a chainsaw. So like, oh no, I'll find something else. So then I saw another job ad, it said accounting. I'm like, well, that can't be too bad. So I ended up there, and it's been a really good fit for me. With Blackburn Group, we do specialise in forestry. I don't know what ratio would be forestry, but I would probably guess and say at least 70, if not 80% of our clients would be forestry based. And why that's quite handy is every day we're seeing different contractors. We're seeing the good ones, the bad ones, and everything in between. We've got, when it comes to looking at how people are structuring their business and what rates they're using, we've got a real good handle on the different sort of levels of operation. We can see changes very quickly with fuel rates and the impacts that it's having on people, even just the variances in the different contracts and regions, because we've got that really sort of scope. All right, so yeah, that's a little bit about my background. And crack into this. So this is just a quick rundown of what I want to talk about today. You've got all my scribbly notes here. So, oops, oh shit, sorry, that wasn't very good, was it? Yeah. Oh, we're pretty close to that. So what I want to talk about today is it's amazing how many people don't read their financial statements. They only get sent out once a year. Most people get their financial statements and they only see 2 numbers. That's the tax bill and the accounting bill. And I think you don't need to know all the numbers in your annual financials, but I reckon there's probably a handful of numbers that you do need to understand. And it's the numbers that your bank manager's looking at, that your financiers are looking at, and that your accountant's looking at, and that the ID are looking at. So you get a handle on that, and there's a few others in there that you should be tracking yourself, because if you're monitoring those, then you've got a good chance that your business is going to survive and be successful, and you're on the right track. And then the important numbers, the cash and bank, that'll take care of itself. The next bit I'm going to talk about is tax and dealing with ID. I know a lot of people have, especially in our industry, have had some pretty hard times. Most people have been on sort of 80%, through winter there, as well as the impact of the storms. There was, some downtime, so people got behind on tax and GSTs and the arrears. And a lot of people, when that happens, they bury their head a little bit. So I want to talk about the ways of sort of what to do when that happens, and the options around it, because there are good options. Next bit, I've got just a little bit of insurance update. Mostly some notes from another local sort of broker that presented. But the insurance industry, as you all know, we've had a massive, all these weather events, and it's changed. Premiums have gone up, and he's just put a bit of background and science to where the insurance industry is and what to expect in the future. And then we'll get into what I think is the good stuff. A lot of this stuff is the backward-facing accounting. The next stuff is what I like to do is the costing and the forward-looking accounting. So when we're talking with our forest managers and trying to get our rate up, we'll just delve into some of the stuff there. The other bit I'm going to talk about that's often a bit confused is the fuel price adjustment and how that works and the effect that has on your rates and ratios. Really relevant because in those last 2 years that fuel price has just gone up, and it's massively changed what that fuel number looks like in your accounts. We'll talk briefly on cash flow management and forecasting. I'm going to talk a little bit about ACC and experience rating. Just had a very good sort of, not wake-up call, but yeah, we came across a client who highlighted quite a good point there, and you can save yourself quite a bit of money if you're aware and sort of looking at that, because often, again, people just get the bill, pay it, whatever. And then I've got a little wrap-up of just odds and sods, all relevant odds and sods. Right. Going back the wrong way. Yeah. So we'll start off with the boring stuff, because this is reading a set of financial statements. So these are all pages from a set of financial accounts. I think most people probably see it pretty similar to that. It's just jumbled, a whole lot of numbers, pretty irrelevant.
Ours, crikeys.
Yeah, used the name. Now I'm pretty sure most people, try and use a pointer. Battery's flat. Most people know how to look at their income. Most people can probably look at the bottom line. But what I wanted to sort of get the head around is that all these numbers in a set of financial accounts link together and flow through, and this is what most people don't really understand, that they'll honestly just pick out the key numbers. So, actually one point I will say is everyone does this differently, is the level of detail. Some people will split out their R&M per machine. You'll get this massive list of R&M, every vehicle, everything. That's fine, that's quite good if you want to track month to month. This machine's cost me a lot, maybe I need to look at replacing it. You can lose yourself in that detail. I'd suggest you're better to, with the accounting systems nowadays, sort of group things, your R&M, your motor vehicles, because when you're assessing your company or you're looking at forecasts, you want to be looking at your ratios. So you want to be going, okay, my R&M's grouped together, it's 8%, yep, I'm happy with that. Whereas if that's broken down machine by machine, it's a lot harder to read. But then if you saw your R&M and you're like, yeah, that figure is 16% of that, that's pretty high, why? And then you drill down into the detail. That's because I did a big refurbishment on my hauler. Yep, I'm happy with that, you're comfortable with it. Just getting back to the flow of numbers, so this number here, depreciation, obviously that links to your asset schedule. This number here, links to your shareholder current account. So not all accountants do this, but we break out our related party transactions. Now the reason we do that is when you're assessing your own results, or your bank's assessing your results often, that figure is not a manipulated figure, but it's a related figure. So we're trying to isolate that figure separately. So anyone looking at this can go, okay, what is my real trading figure, which is effectively your trading income, less those expenses, and that cost of depreciation. So that's more the figure that, from a bank's point of view, you want them to be focusing on. You don't want that lumped in, buried into there, because all of a sudden your bank's going, oh, well, there's a big difference between that 537,000 and that 370,000. But we use this figure here to manipulate our overall tax planning a little bit. So when we do a set of accounts, we'll come to the end of the year with this section here, and we'll go, okay, there's profit of that. Tax-wise, what's the best way to allocate that profit? And this is where we might do a shareholder salary. Here we've got a management fee to another related entity. So we're splitting things out tax-wise. So this net figure here is then the figure that drives your tax return, and you'll see that figure in your tax return. Now I've slot this in here just because it relates to the profit and loss more. But these are the main expenses for your forestry contractors. And there is differences between the ground base and the hauler crew and different things. But I would suggest that if you are focusing on these key areas, I mean, your turnover you should have set from your costing. Then if you're focusing on your fuel and oil, your wages, ACC and R&M, and you're sort of operating in those ratios, then a lot of everything else is going to take care of itself. The only other ratio that is really relevant and important is one that they call the EBITDA, which is the earnings before tax, depreciation and amortization. But your financier will look at that. You don't need to worry about that. There's a bit more calculation to that. But that's basically talking about how much net profit you have to pay your finance. But they will look at that. We'll touch on it briefly later on, but that's the one that they'll take care of. If you take care of this, then you'll be a long way to taking care of the other ratio.
So when you say a percentage, is that a percentage of your total cost or a percentage of your
turnover? Yeah. So the next page in the set of statements is the financial, the movements in equity. And if I just go back, you'll see this last figure here on the profit and loss, 665. These slides are quite blurry. They were hard to get in from a PDF. That carries through to this figure here. This equity page, probably not the least important page of a set of financial statements, but it really is just showing, bringing the profit through, and it will record if there's dividends, and we'll talk about dividends and why they're important later on. And it'll also record if you've sold an asset, got a capital gain, that's a reserve, that'll show in there. And this figure here, this 40,206, that's effectively the company's net asset at that point. And that figure will link through. So yeah, that's just really recording. That figure will link through to the balance sheet. And we'll go to the balance sheet here. So going through the balance sheet, most people will probably look at their balance sheet because that's where it has the bank account and the cash on hand. And it also shows your assets, your net assets and your liabilities. Asset schedule here, so that plant, property and equipment, that's our fixed asset. For our loggers, that's quite a key number as well. A lot of value tied to that. The shareholder current accounts, so that's effectively the sum of what the company owes or we owe the company at any given time. And so there's a separate section in their set of accounts called the shareholder current account. Now getting back to this equity, this is probably the main bit I wanted to highlight on the balance sheet. Now that 40,206, that's our figure from the movements in equity page before. Now the reason this is important, and this is what a lot of people, even accountants that we sort of, if we take on new clients from other accountants, that people aren't looking at, I would call this one of the key figures you need to start looking at in your own accounts. Because what what we're noticing is this figures can be quite large and building up. Now this figure, when you wind up your company or you go to cease, this figure needs to be nil, so you need to declare that figure out by doing dividends at the end of the year. And so, I'm not explaining this very well, hang on. So actually two things with this number. Actually, this is the go back a little bit. This is the at-risk portion from a health and safety point of view. So if this is a large number in your logging company and you have a health and safety incident, then that net equity in there is at risk from, say, a lawsuit. So for our logging guys, we like to have a company in a trust structure, and we'll try and declare dividends and keep that figure low and shift any equity across to our trust purely for safekeeping from any health and safety risk. But the other factor to this is any company that has a balance in here, when they go to wind up or close, they have to pay that they have to pay that out, and you do that by paying dividends. Now, when you pay a dividend, you have to attach tax credits. So company tax rate is 28%. Yep. The trust tax rate is 33 at the moment. So when you pay a dividend, because generally you often have a trust shareholder, you have to pay that extra 5% tax. So it's voluntary when you do it, but it's only ever a timing of when you pay that tax. And what we see with a lot of other companies, especially if people come to us for the first time, is accountants aren't declaring dividends. They don't want to tell their clients, oh, you need to pay an extra 5% so we can declare this dividend to get this figure down. They're reluctant to do that, and it's building up, building up, building up. Now what's happened is under the Labor government, they've mooted a change to a top tax rate for trusts of 39%. So rather than 5% extra, there's going to be an extra 6% tax on that. So another 11% for the same result to declare that dividend. So if you've deferred that liability, it's building up, building up.
So that's when you close a business and you transfer that equity through to a trust or whatever.
Yeah. But you need to be, well, I think you need to be sort of transferring it regularly to keep that asset, that net asset down from especially in logging from a risk point of view.
So does that 39% come in, or it's coming in?
It's, well, they're still trying to form a government at the moment, so at this point, we heard National were quite keen to maybe cancel it, but then the issue they've got, and this is coming from another tax expert we had, was that they need tax take. They've got all these promises, and now they're going to have even more convoluted sort of coming together policy, and there's going to be some basically they need to fund tax. So I can see them. We tend to think that they'll probably leave it and just blame Labor. They'll say, look, this is Labor's mess, we're stuck with it, but it'll serve their purpose quite nicely because they'll have that extra tax coming in. So they might offer a tax cut somewhere else, but it probably will be funded by this trust tax rate. At this stage, last I heard, it hadn't been signed off in government yet. But if they were talking year 1 April, it comes in. So this year for a lot of our loggers, we're going through a process of trying to work out what they should, what tax they would need to pay to be able to declare that out in the maximum. So part of that's forecasting for the current year, trying to work out, okay, well, we think your profit's going to be this much for the current year. We think the tax on that at 28% will be this. If you pay that early, and if you pay this extra 5%, then you can save yourself 6% next year by paying it early. Now, talking to this retained earnings figure and about clearing it out, when it comes to calculating the dividend, this figure here is net of imputation credits. So does anyone know what imputation credits are? Imputation credits are prepaid tax. So when you pay that tax at the company tax rate of 28%, that creates an imputation credit. Now that imputation credit is then transferred with the dividend as a prepaid credit. And then the 5% is what they call DWT. So if your accountant asks you to pay DWT, that's that extra 5%. Yeah, so just working the maths through from our retained earnings of 17,606 to gross up for the prepaid 28%. The dividend that you'd be declaring is 24,452. And it attached with those credits. Now, by this stage, they're prepaid. You're not paying that, but you would have to fund the 1,222 of DWT. This is a pretty small number for the loggers. I know that this client here, they had a massive share change in this year. So we declared, because of the share change, there was rules we had to declare as much income and get that right down, or else they would have lost those imputation credits.
No, sorry. So with doing that, with taking out and putting in a trust.
Yeah.
Do you need to still keep that to a certain amount in there, like with the finance company and that, looking at that with your equity?
Now, mostly with finance companies, what they'll say is they'll focus more on the shareholder. If I can go back.
So is that showing in there what?
Yeah, so often,
the trust?
so the trust will be basically linked to the shareholder current account. So anything that happens down here of allocating dividend will go to the shareholder current account. And so this is quite busy, I don't know if you guys can see, but here's a trust here. So if we focus on trust one, you can see that they had dividends here of 110,000. They also put some money in, 20K going in, and there's a journal here, interest on current account. So what we do, now the way I like to describe the shareholder current account is this is a bit like, this records the money that you put into a company and the money that you take out. It's that simple. It's like your bank account in a company. And similar to a bank account, the company can pay you interest if you're in credit, which is what we've done here, which is why they've got that extra 23,000, which is another way of shifting equity. It's another way of shifting profit across to the safekeeping of the trust. But if this number was overdrawn down here, if that was overdrawn by 704,000, then IRD require us to also charge interest and at IRD rates, which I think the current FBT rate's about 10.91%. And that becomes a little money go round journal. It's not that you have to physically then pay the company, but it's a journal entry that will boost the profit, the income of the company, and make that overdrawn amount bigger. But the shareholder current account's another area that I think, we've got that, well, of course the profit and loss, but I think that equity number's quite key to look at and just see how that's tracking and what your potential dividend liability might be. The shareholder current account's another one that I think people need to pay attention to. And the reason is, banks and financiers don't like it if you've got really high drawings and it's massively overdrawn. And you do sometimes find a banking covenant that will cover that. You can only take so much out a year or sort of got to be within a certain ratio. But then the flip side of that is if this is like these guys, 704,000 in there, if that's in credit, there's other things that can be quite beneficial that could be used to maybe buy more shares by the other shareholder. You can do a fund like that. If you had a private mortgage and maybe 500,000, the company can borrow that 500,000. You take it out as drawings, and it comes off there, and all of a sudden that interest is deductible. So it is worth looking at your shareholder current account and going, okay, can I refinance in the company, get the interest deductibility, and pay off my personal debt, or can I got a good balance here? Can I look to buy out the other shareholder? Often what we do a lot of is key person, whether it's the foreman or just a key operator, as part of that succession planning, they will buy, often it's 25%, they'll put in a bit of money with the idea that over time, we're declaring dividends, this balance is going up, and they'll get to a point, they don't ever really see the money of those dividends, they just see this value building up, but then they can start buying more shares off the other person, of the main shareholder, till eventually they get to 49%. And then it's an all or nothing situation after that. They have to buy 51 shares Again, same process, just build up the shareholder current account, and then they eventually take over and the business is their own. So yeah, I think shareholder current account's really important.
Why would they not be showing any drawings?
This trust here, they just didn't basically take any, but effectively he's the foreman of this crew. He has paid a good salary, which is shown on the profit and loss.
Right.
So yeah, no real need for drawings. But that's one question I get a lot as well, is tax on drawings. There is no tax on drawings. Doesn't matter how much drawings you take, there's no tax on it, because it's effectively pre-tax when it hits here. You can't, so if you're looking at the increases, things that can increase it, you've got your dividends, you've got the interest, funds introduced. You can't just take drawings forever and you end up in that overdrawn situation, which again creates that interest journal. So yeah, you treat it like a bank account. You need money going into this, or journals going into it at least, to keep boosting this balance before you sort of take drawings. It's not life and death having that overdrawn current account, but like any sort of debt, it just seems to create a bigger and bigger hole. And again, from a risk point of view, if this is large, if this is 700k overdrawn, you have a health and safety accident, they can come after this and say, well, hang on, you've got a liability to this company of 704,000. We need some money to cover some lawsuits. Then that's liable as well. So another reason to not have that massively overdrawn. All right, the next page in the set of financial accounts is asset schedule. I've just picked on this. I think this is a fella bunch here and highlighted. So this is talking about often the cost price versus market value. And I just wanted to sort of highlight a little bit what happens when you sell for a profit, for a loss, and if you sell for a really good profit and you get a capital gain, and just how that affects your tax. So here you can see we've had the machine for a few years. It's got a closing value now after purchase value of 720,000 of 497. That's our book value. So then we go to sell it. Got a market value here, or a sale price of 650,000. The depreciation recovered on that is 552. Now that's at 222,309. That's our total depreciation claimed at that point of sale. So this is effectively a clawback on the sale price of that value. Now why that's important is that'll generate a tax bill. That's going straight to your profit and loss, and so yeah, you're going to get an extra 50 grand of tax on that. Really good one for haulers, because they just hold their value so well, and I've seen some pretty horrendous tax bills based on that depreciation recovered number. So yeah, so there's like I said, the 50 grand tax effect. Company tax rate is 28. I've used 33 because of that dividend. You eventually have to get that profit out at 33. So what happens if we sell at a loss? It does reduce your profit. There's people like that. Oh yeah, I'll save myself some tax. So we've sold. So yeah, you do get to claim that loss. You'll get to claim that 97. Feels quite good at the time. Effectively you saved yourself 32 grand in tax, but there is a net equity loss of the 60 in between. You're still having to fund that somewhere, and you effectively have lost 60. Again, sometimes this happens with certain machines where you actually sell it for more than you paid for it. Some clients tend to do this more than others. They seem to be very good at sort of buying older machines and fixing them up and expensing the R&M. So you are going to get hit with the tax on that depreciation recovered. So you're still going to cop that 50 there, you're copping it all. Actually, that's the full amount. It maxes out at that. It doesn't go above that. And the balance above that goes to capital gain, which will go to that movement in equity. Sits here as a reserve. No tax on that. So that's a good one to get. So what I do see some of our more savvier people doing is when they're going to buy or replace a machine, rather than going into the yard and trying to talk up a high trade price for their old machine, they'll talk a low trade price for their old machine, just I'll give it away, but take that off the new price. So all of a sudden, they've reduced the depreciation recovered. And effectively, if you keep, and then if they're getting that off the new machine price, that same sort of value difference, eventually they can get into that capital gain. You keep trading like that. So yeah, it's funny, some people have the very much gift of the gab on that. Right, finally, working through the set of accounts, we've finally got to the tax return. Pretty obvious, most of the stuff here. That's the figure that came from our P&L. That's our tax figure. This is the tax we paid during the year. Now, we all know that, well, hopefully we all know that we have provisional tax dates. We've got 3 provisional tax payments throughout the year. If you've got a March balance date, which most of the loggers have, it's only the farmers that generally have a funny balance date. Your first one's 28th of August, then the 15th of January, and the final one is 7th of May. Now this prov payments is effectively, it goes off the prior year's tax. It doesn't go off your current trading. So it goes off the prior year tax plus 5% if you've filed your return, your most recent return, or plus 10% if you're a bit late, you know, say if you're only filing in February, it'll be plus 10% of your prior year. And so yeah, off that number. But the key rule here that I want to talk about is timing. So IRD has a rule that if your residual income tax, which is your residual income tax is the tax left to pay, if that is over 60K, then you're liable for use of money interest on any underpaid tax. So where that's important is when you're assessing these provisional tax payments and what you should pay. You know, you file your return IRD, and it'll be IRD, there'll be a schedule of what you should pay. But if your income's changed dramatically from this, and you get to the sort of end of March and you go, I've had a really, really good year this year, and you know that your RIT's going to be over the 60, you want to be assessing that before this 7th of May payment. Yeah, I may be only scheduled to pay 103,000, but I know I've made another 300K profit on top of that. You want to be thinking, okay, I need to pay an extra 100K at that 7th of May date, because if you don't, and if you delay it, terminal tax isn't to a year following April, the year following, you're going to be charged use of money interest at currently 10.91% for that year on that underpaid tax, that 100K. So hopefully your accountants are looking at this and monitoring that and telling you, giving you the heads up of, yep, you're tracking really well. Conversely, if you've had a really tough year, I know a lot of crews have been on quota for a long time and coming off boomer times, it might be the opposite. It might be getting to this payment and going, actually, don't bother, you don't need to. Take that stress out of it.
Is that still reassessed at the end of the 3rd quarter?
What do you mean reassessed at the end of the 3rd quarter?
Are you supposed to do a reassessment of your own accounts at the end of the 3rd quarter to see if you're going to be up or under?
It's not mandated by everyone. It's up to the purpose. Yeah, the person. Yeah. But like I say, like we do it for our clients when we type to GSTs. So you know, especially for our real big clients, we know there's things going on. We've started to look at tax estimates now. They don't have to pay anything. You know, even though we're looking at them now, they don't have to pay anything early. That's still not due until then. But it's just giving them the awareness of you're tracking pretty well. You should maybe increase what you're putting aside, or you can expect this. But definitely once we come back from Christmas, that's our focus, is just looking at those GST reports and really honing in on what people are doing. But we don't do that periodic reporting for all of our clients. You know, some people only come to us for their annuals, so we don't see what they're tracking, and it's up to them.
What's the interest rate at the moment for the other way, for the IRD?
What was they paying if you overpaid? About 4.67. It was nil for a long time. They've finally, as the rates have sort of crept up, they've got a bit more lenient. Yeah. I'll talk a bit more about some of the tax payment options in the next little section actually, which there are some tax intermediary options rather than just dealing straight with IID. Right, so that was the end of the real boring, dry stuff. There's no way to make talking about a set of accounts exciting. I couldn't think of it anyway.
That was good.
But yeah, I think as a takeaway, I think if you really just focus on your profit and those key ratios, that's a really good start. Have a look at your equity, because that is essentially your risk. And also that current account, again, partly risk and partly what you can look to take out as drawings and yeah, consider options. Right, so this next section is dealing with IID. Making a payment sounds really easy. It's amazing how many people actually, everything's online now. I mean, the bank programs generally step you through, but it's amazing how many people send text to the wrong type, to the wrong period. So I thought I'd talk just really briefly about how to make a payment online. When you're in your online banking, under the particulars, just put in your ID number. Make sure if you've got multiple entities that it's the right ID number for that entity. A lot of people will just pay tax from the company, and then that tax might cover the trust and the individuals. So things do go skew with there. Then in the payee code, you need to put the tax type and the period. So here you can see it's GST 31st of August 2023. That format will have it go to the right tax code. And the reference, just leave it blank. Common tax codes, these will be the main ones that you need to use. Income tax, pretty self-explanatory. GST, DED for your payroll stuff. Your lovely accountant might tell you to pay some DWT, so DWT. Now this AAR, we'll talk a little bit later on, but that's effectively if you've got an instalment arrangement with ID, so you might have fallen behind on something and you ring them up and say, look, I just, just need to spread my payments a little bit. They'll get you to use that ARR code, and now that instalment arrangement can cover GST, PAY, income tax, but put it under ARR and then it'll hit IID. They'll tick that you've stuck to your instalment and split it off to where it needs to go. IPS. IPS is effectively where we've done that withholding tax on interest. So we've journaled an interest either paid or received, and then we're asking you to pay the 33% RWT on that attaches to that interest, like a bank. So when you get a bank, you look at your bank statement, you'll get the interest coming in, and then you get the tax going out. Essentially that, you just physically pay that tax figure. If you're doing that between a related entity, the flip side is they're claiming that tax figure. It's not dead money, it's not lost. You are getting the tax benefit of that. Right, what to do when you can't make a payment? Again, this happens quite a bit. Yeah, pretty self-explanatory. Amazing how often it happens. Not the best thing to do. Really, if you can, just preempt and contact them early, but here's why. So this is what I've called the snowball. So you talk about that use some money interest. The current IID rate is 10.91, so anything underpaid, that's what they're going to be charging you on. They'll charge that on their penalties and interest as well. The late payment penalties comes in 3 stages. 1% on the due date, 4% after the 7th day, so in that first week, 5% being underpaid, and then 1% every month after, which is why with that 5%, especially for the numbers that can be involved with our loggers, that can be easily sort of $3-5 grand, boom, after the first week, just because you're late paid. And what happens is people go, I can do that in a couple of weeks, I'll pay it in a couple of weeks, but by then they've already incurred that 5%. Whereas with being a little bit sort of organised and pre-planned, you can negate that. So yeah, this is my number 2 rule. Make contact before the due date. If you know that you're not going to be able to meet your payments, either ring your accountant or even ring IID directly and say, yep, I'm not going to be able to make my payments, and have a bit of a, just come up with a plan, preempt it. The reason that is important is if you enter a scheme of arrangement or whatever, it will stop those late payment penalties effectively. So you might get copped with a bit of interest, but you're going to avoid those 5% in penalties. But there are other options there. So your first option, if you fall behind, can't make a payment, is IID scheme of arrangement. It avoids those late payment penalties, still got the interest. You can apply yourself, you don't need your accountant to apply. If you've got a My IR login, and people got those, use them, check. Pretty easy to get. It's where you can check all your tax and what's going on. You can set up an arrangement yourself, and basically all you need to know is what level of repayment you can stick to. They don't like resetting arrangements, so if you go, yeah, I can pay 15 grand a month for the next 3 months, and that'll catch me up, and you can stick to that. They do require you to keep current on any new tax, so if you're stretching your instalment out over a year or whatever, you still need they don't like resetting, they don't like adding in new tax to it, so just have a really good think about, no, I can stick to that 15 grand a month. You can also stipulate the day it comes out of your bank account, which is, I recommend, sort of being the 22nd for most of our contractors, just while there's money there before it sort of goes away. And at the moment, I do have clients that have stretched that out to 2 years. And with the new IID system, we have, with the IID, they did a big computer upgrade several years ago, and we're actually quite lucky. They've actually starting to have reasonable online systems, and if you fit the criteria, this will largely go through, just no questions asked. It's only if it's really large and a bit bodgy that they'll come back and query you on, can you commit to this, and why are we doing this for you again? So yeah, we're pretty lucky here compared to, I've been dealing a lot with Australian tax ATO over there, and they're miles behind. They're a very cumbersome system. But there is another option, and that's tax pooling. Has anyone heard of tax pooling? So this is buying tax from a tax intermediary. So these two companies, we mostly deal with these guys, but we have dealt with these guys in the past. Basically what they do is they buy and sell tax. So they basically have a pool of predated tax, and you go to them and say, yeah, I need some tax back in August last year. And they'll go, right, okay, well, we'll sell you that tax in August last year. They'll transfer it to IID, and it'll be at a rate lower than that IID 10.91, it's generally a couple of % lower. But by transferring it at that earlier date, you negate those penalties, those IID penalties, so it's an option. And they also have a range of payment options, whether it's instalment or just they have a pay-as-you-go option sort of thing. You can book it in advance. There's lots of different options. We have clients that, well, I've got one large client. He just puts, and he's got sort of, he's probably got about 5 companies, and they're all commonly owned, so he can sort of have them all grouped under this, and he puts 100K a month to this tax traders, and so he knows he's putting tax aside, leaves it to us at the end of the year to do his accounts. We sort of work out and shift things to the most optimal way, and then we go into tax traders and say, okay, we need this to go there, this to go there, this to go there, and because he's he's not prepaying, because he's putting money aside, he's reducing his interest costs with tax traders, and in fact, if he ends up in credit, he does earn interest. I think he earns slightly better interest than IID as well. But it also, so that's the way he uses to manage his tax, rather than sort of having to worry about 5 different companies, 5 different prov payments at his prov date, and the fluctuations that arise. It's also a lot easier if you've overpaid your tax to get the money out of these guys. If you get to sort of Christmas and you go, actually, I don't need all that tax that I've put aside. It's a lot easier to get out of these guys than IID if you know that you're going to be not requiring it. So yeah, quite a good option. And I think as people understand what they do a bit more, there's been a lot more uptake and use of them. This is kind of the third option, and I consider this a last resort, and this is IID debt remission. Big IID for debt remission. It's amazing how often, well, not often, but I have been asked, serious hardship, must be able to get written off. You do hear some big write-offs occasionally. Wouldn't say it's part of the course. Definitely IID's been pretty good in recent times, just with the stresses that have been going on to certain industries and individuals. but you just never know, and it really is a last resort. The criteria, well, basically, when you get to this situation, the IRD, the commissioner they call him, his scope is he needs to basically recover as much money from you as he can. So often, yeah, the criteria for serious hardship, it's pretty hard to meet. I did scribble it down somewhere. Just feeling poor isn't enough. Yeah, so to be considered for serious hardship, they will consider serious illness, or else they have a clause about unable to meet your minimum living expenses of a normal community. I don't quite know what that means, but it's a pretty high benchmark of pretty much not being able to, not live with a degree of comfort, but live, I think is the way to describe it. Again, if paying the tax debt would mean that you can't meet your medical treatment for yourselves or a dependent, or if you can't meet educational costs for a dependent, that's pretty much restricted that. So it is quite tough. Oh yeah, I should be reading my notes. Here we go. Yeah, IRD, when it comes to penalties, they do have discretion to remit penalties. So generally this is for things outside of your control. It might be that you had a sick kid, you're in hospital, you're in Starship for a week, you miss paying your GST because you're in Starship, you had just other things going on. You can request a remission and they're generally pretty good. They only remit interest in where there's a declared emergency event, so the floods. They've got discretion then to remit interest. What have I got here? Yep. Just a minute. Okay. Prioritise tax payments to PAYE and employees. Now, the reason I got this up here is if you don't pay your PAYE, you are basically stealing from your employees. It is a criminal offence and you can go to jail. So if you've got tax arrears, prioritise paying your PAYE. You're a lot better to go to the sword owing GST and income tax than PAYE, point blank. So I'll skip to the next section, which, I just want to talk about insurance. A lot of this is more just general sort of background and a bit of relevance, but hopefully some good reminders in here. So we'll talk about cover, flat interest rates. This is just one of my pet hates. We'll get to that. And then, like I said before, there's some slides in here from a local broker, not promoting him, but it was some quite interesting reading just for the current environment. And pretty irrelevant. I think we're going to be facing high insurance costs for a little while to come. So pretty obvious, and it's again, amazing how often it doesn't happen, is regularly just delete old assets. Go through your schedule of what's covered. Make sure, it's amazing how often, we'll be doing a set of accounts and someone will be like, oh no, I sold that, sold that old machine, it's gone. So make sure that's actually, you're not paying for it in your insurance. And as things are getting older, review the cover value. Does it need to be insured for 800k, or is it now only worth 500? They will only pay market value. So you could be paying more than you need for the cover you're actually going to get. And of course, check new assets are included. Now this is one of my pet hates. This is flat rate interest. So who pays off their insurance? To the insurance brokers? Or do you just pay it on the invoice? Don't know. A lot of people will pay their insurance over 10 months via their broker. Sounds like a good idea, save your cash flow. Insurance companies, and I haven't seen one that doesn't, use a flat rate interest calculation. What that means is is generally when you take out a mortgage, it's an annual interest rate. The interest calculates off a reducing balance. With insurance companies, they don't do that. They calculate a flat rate off the initial borrowing. And this is actually off a statement. You don't often see it like this. They'll sell you on a 10% interest rate. They'll say, oh, look, just pay it off over 10 months, 10% interest rate. And you go, yeah, okay, that's what I'd be paying at the bank. But the annual interest rate equivalent is 26.21%. Now, if you said to someone, would you like to pay 26.21% on your borrowing? Most people would go, no, I'm okay, thanks. And in this example, this is only this isn't a logger, so it's not a massive premium like a logger would have. He hasn't got the machines to insure it. But these guys have money in the bank. There was no reason they couldn't just pay this and avoid this. So for me, it's pet hate because it's money for jam and it's money that people just throw away. Yeah, so, and even if you were tight on cash flow, you could probably, overdraft rate's probably not much more than that at the moment. It's 10, 11%. So yeah, so save yourself some money and just pay your interest. I reckon for a decent sized logging crew, based on this figure here, you're probably saving at least $3 to $4 grand just by not paying your broker. And negotiate with your broker. Most brokers will give you 3 months to pay off. So if you want to spread it, just say, look, yeah, I'm keen, I'm happy with the policies, the renewals. I'll just pay it off over 3 months, no interest. Spread it that way. It's only a minor thing, but it just, I don't know, it irks me. Yeah, so this was the next few slides are from Crombie Lockwood. They've since changed the name, I think, recently, but this is from Andy Jensen in Taupo. And basically talking about the state of insurance. I mean, it's a lot of stuff we all know. We know inflation's gone up, 32-year high. Labour rate's gone up, cost of building's gone up. We've had all these weather events, retail crime, smash and grabs, more large fires across New Zealand, increasing number of motor accidents, larger population, more newer vehicles. I think it was a little while ago where the government sort of got rid of all those old Jap imports, and you probably do see a higher spec of vehicle nowadays on the roads than what we did have sort of 10, 15 years ago. And those cars have a lot more technology in them, so all of a sudden just replacing a windscreen, a lot of repairers don't include that anymore because the windscreen's got all these additional sensors and everything else. And so yeah, the reinsurance costs have increased. Insured losses globally are expected to top 100 billion for the third year in a row. So that's a massive hole that insurance companies are trying to plug, and they're trying to claw that back from us. So this is what Andy said is, yeah, expect premiums to keep on increasing. Another 20 to 25% this year, which is massive. It probably jumped up, probably similar in that last little year, I think, if you look at a lot of the premiums. And of course driven by all these climate change events. He seems to think certain areas will be a lot more targeted insurance, where rather than having sort of the blanket approach regionally, certain areas and industries might get a bit drilled down a bit harder. And he talks about the trend likely to continue for the next renewal cycle and beyond. So this is where the insurance market cycle is now. And as you can see, the insurers have had these massive loss events, dips in profit that's eaten into their capital and what they can actually insure. So there's a lot of underwriters I know from the machinery point of view, underwriters that were in the market have exited, so there's a lot less options now. So you're really stuck with, from my memory, there's 2 or 3 main players now that are sort of operating in that space, which means they can charge a high premium. There isn't a competition, and it's going to be a little while before it starts to drop again. We're going to need to sort of not have these weather events and for insurers to sort of enter back into the market, provide a bit of competition. We're running quite quick. So the next, yeah, bit was,
Questions there too.
oh yeah, I might need a drink actually. Right. I was hoping to sort of get to costings after lunch, but anyway. Is what it is. We might end up finishing quite early, but.
Oh, that's
Mm.
unless anyone's got any questions at this point.
Yeah, definitely. I'm happy to answer any questions as we go along. It's probably easier when we're looking at different slides rather than going back later on. But anyway, we'll launch into crew costings. This is an area that I quite enjoy looking at, other than, compared to the compliance stuff, the costing stuff isn't black and white. There's a lot of moving parts to it. Sometimes you feel like there's not necessarily a right answer, but there can be a wrong answer. So yeah, and it's just it's an evolving space, and every time you're asked to do a job, it's always slightly different. But costing wise, prior to 2020, we had reasonably low inflation. We had little fuel price movement. I think, back in sort of 2019, we were probably costing off $1.10 fuel price. And then sort of we had COVID and then the war in Ukraine, and ever since then, prices have just escalated. But even prior to that, before then, we also experienced sort of the change in the last sort of 10, 15 years from manual crews to the increasing mechanisation, and that's changed rates as we've gone along. I was saying to Prue before, if you were to cost a job and you cost a manual crew compared to a mechanised crew, the manual's still cheaper.
Or you've got more high skilled people.
But
You're having to pay more, but not to downplay it, but when you were manual, your staff,
yeah,
you didn't need anyone that knew how to operate a machine, they just had to know how to operate a
yeah,
chainsaw, whereas we've gone to people who are very skilled in what they do, so you've got to pay.
yeah, and just the owning cost of the machines. I mean,
And that's
like
but
you know,
cut down some staffing, but the cost
Mm.
in wages has just grown exponentially.
and you lose your flexibility as well. All of a sudden, when you've got millions of dollars of machines sitting there, they need to be working. So when the forest manager comes and said, the price isn't very good, you mind cutting back a little bit? You're like, oh, I do actually. Whereas if you've got a bunch of guys, you're like, okay, well, half of them are rat bags anyway, we'll just ditch them for a bit. So there has been massive changes around that, and it's definitely in those last few years, it's been really, really hard to keep pace of costings, and I've definitely seen people go backwards. Like I say, just stuck in the old mindset, and that includes just even some of the discussions we've had with some of the forest managers when we've sort of submitted our rates, and they're going, no way we're paying that, and it's trying to get everyone on board and sort of talk to, no, well, this is actually what it costs now. There's no smoke and mirrors. This is what it costs, and it's been very hard to get people up to speed, and it has just changed so fast. I mean, when I started, a man day rate was $280 a day, and now, at $450, people don't even hardly question it. It's pretty much the norm. Yeah, this is what I've got there. Yeah, well, who's heard of the form numbers? Most people heard of the form numbers, yep. So Form's an outfit down in Wellington that do forestry costings as well, and they release their sort of machine costs and labour costs on a yearly basis. And what they do is really good. It provides a good benchmark for everyone in the industry. You can sign up and get the reports. What I noticed, particularly last year, is that a lot of people were reliant on those form numbers, but you have to remember when those form numbers come out, they're already a year behind. And with the way that costs and rates ramped up in that 22, 23 year, they were old numbers by the time, people, so we were getting sort of measured against them, and it was a really tough fight. So just if you're relying on those, just remember that they are very backwards facing. So I want to crack into fuel price adjustment. Hopefully most of you got a fuel price adjustment clause in your contracts. Yeah. So here we have, this is a basic sort of costing that we would sort of submit to a forest manager when we're sort of talking about a rate. So we've got our machines up here, that covers the running costs and the owning costs. General accessories or tools, signs, whatever else, allowance for that. Chainsaws, always seem to have just one chainsaw nowadays. Vehicles and travel, basically that's just at the IID rate, it doesn't have to be, that's what we've just used in that example there. And then our labour costs. Admin, got allowed for those accounting fees. Now the other thing we put in here is what fuel rate we've used, because by changing that fuel rate, changes those. And just as a reference point, what percentage that comes out at. Because again, by changing that fuel rate, changes that percentage as those costs change. And I've tried to highlight that over here. So here we have, this is our day rate per this costing. 11,961. Fuel rate over there, $1.50 at our 16.58%. If that rate was $1, and some of those older contracts might have been written up in 2019, they had a $1 base rate. That costing would be 11,344, and the ratio is 12%. So one hand, it's almost this movement in the fuel ratio that I really want to highlight. That's the key bit. Conversely, fuel price is $2. Day rate's 556. Then the ratio climbs up to 20.66%. So the only thing I've changed is that fuel price, and it's interesting how it changes that ratio, even though, as we see later on in the actual income side of it, we're getting this fuel price adjustment. It changes that fuel ratio as an overall cost. Oh, this is just out of interest. This is roughly how the fuel percentage has moved through as we've mechanised into that higher fuel environment. Again, I pick on forest managers. They're very stuck in some of these historical numbers, and they've been very slow to adjust the fuel percentage in the contract. I noticed that Money Life came out a couple of weeks ago with a new standardised contract that they're bringing out, and they've gone to a 15% fuel percentage for their fuel rate adjustment.
Just a quick question about fuel. Does that include AdBlue?
I would include it. Yeah, I generally treat this. Yeah, I would treat that as in that figure. Yeah. So just, I mean, I don't know. Yeah, I just want to sort of explain how that fuel adjustment works, because what we've found is that actually some forest companies actually aren't applying it correctly. Most are, but just don't assume that they're applying it correctly either. It does pays to sort of understand it and maybe calculate yourself every now and then, just to go, yep, it has been checked. So this is a clause. This is cut out of a contract. So this is the agreed rate. It'll tell you the start price, and so that's your benchmark. You're going to move up and down from that. I've used a different sort of start price and benchmark, but it was just to show that was straight out of a contract that I had a look at. So what they're trying to do with the fuel rate adjustment is compensate you or adjust the rate down for that change in fuel price. So if you think of this percentage, this fuel percentage, as your at-risk rate of that price fluctuation. So per hour costing, we've got our base rate of that, and our costed percentage is that. So our per tonne rate was 47.85. I know that the fuel rate is, per the contract, is 15. Let me just Just get my notes.
Oops, gone back.
These fat fingers. So if I'm working out that, basically times 15 times that will give you that. And if you want to look at it on a per tonne basis, so that's my base daily fuel cost. Here I've got my base rate to the new current price. Do the maths on that. That's a movement of 19.21%. So now I need to add that movement to my base fuel cost, which will give me my adjusted fuel rate. So then you add that adjusted fuel rate back in to your day rate to get your day rate, your new day rate of 12,306. So that's an increase of $344.68 a day. You can negotiate on that fuel percentage, and what you'll notice is if you look back at the costing, our costings will generally be a couple of percent at least higher than what the contract will be. Some of that is a bit of buffer and a bit of margin, but you're also hedging your bets a little bit as well. So hence all the crystal ball thing. You can, in the past, people used to sort of play the percentages a little bit to try and maximise the price going up, and sort of getting a greater adjustment. But conversely, if your price goes down, you get more taken out. So yeah, it is a balancing act. Think of it as your risk potential. But I think with mechanisation, I'm a bit of an advocate for just having a fair rate. So 15 for most mech crews at the moment is probably quite fair. Then you can also talk about and negotiate how often it's reviewed. Again, I prefer monthly. Some people were quarterly. Some people, some of your woodlot guys don't get it at all. But and if you're a woodlot guy and you're not getting it, you do need to factor that into your rate when you're setting it. You need to build in quite a buffer based on your expectations of what you think fuel might do. You've got to be part economist and read your crystal ball. I did see a number that sort of suggested if you're a woodlot guy, you possibly need a 10% buffer on where you think your rate is currently, just to facilitate that movement if it goes up. Because you can see, fuel now, it quickly eats into your profits if it changes and you're not getting enough to compensate it.
Just that change there, I mean, $344 difference or $345 difference a day times 6 days or 4 or 5
Yeah, it's quite scary how it eats up, and it just shows you. I think with just general crews nowadays, just to run a crew is an average crew does. I don't know, it's easily 10 grand nowadays. It's amazing how quickly you can dig a hole, which ties in nicely to the next little bit actually. When they do these contracts, so one of the keys is to have a reference point for your opening fuel price that you can benchmark to. Now, that reference point should be available to everyone to look at, because they ask how can you check that they're applying it correctly to your rate. We've talked about considering the frequency of adjustment, and you check it's been applied correctly. The most common benchmark rate you'll find is under the Ministry of, what are they? MBIE, can't escape me. They have a set of tables in there where they track the weekly fuel price. Now the one they use is column K. That's a massive spreadsheet, lots of different columns, but if you focus on column K, which is the diesel price excluding taxes paid into New Zealand, that's the one that I'd say, majority of contracts that we see use and reference. So it's pretty easy, it's publicly available, it's easy to go in there and say, yep, when my contract was written up, price was $1.50. Today, fuel's $1.76. It's moved that 19%, and just work out that they're applying it correctly to your rate. So this is quite an interesting so with this fuel price adjustment, when you're looking at how you're going, it can skew the way you interpret things. So I've sort of got this up here, hopefully you can read it, how much is the actual production increase. So we've got 2023, we've got contract receipts of 3,204,000, and that's up 562,000 on the prior year. So you think, damn, we've had a really good year. It's been great. But that has those fuel price adjustments, and in this period, we know that fuel went up from whatever it was to this period was hitting $2 at points. So if we then look at our fuel cost, we can see, okay, well, yep, that's gone up 183,000 as well. So, and we can see that increase in the percentage. So I'd suggest that when you're assessing, after patting yourself on the back, that maybe you want to take that off that, and that'll give you, okay, we're still up by 378. Yeah, you probably still give yourself a pat on the back. As someone pointed out to me after I've done this, there's probably a 6% inflation figure in there as well. So you probably adjust another 100K off that as well. But anyway, it's when you're looking at results for loggers, you do need to look at your fuel price and adjust that off your income to get a handle on what you're doing. Now, I had a financier ask me this: how come your fuel ratio's gone up? You know, you say you're doing better, but your fuel ratio has gone up. If you're getting a fuel price adjustment, shouldn't it be the same? No, because when we change that fuel price in those earlier examples, it changes the percentage. What it does on the percentage is it'll increase on the fuel, but it'll drop on your other expenses. Because what we're saying is that fuel price adjustment is reimbursing us for that increased fuel cost, which means that as a percentage of this number here of our turnover, it's reducing for the other expenses, if that makes sense.
It does.
Yeah.
Why do you do it that way though? Can't you do it? It seems.
If you're increasing your fuel,
Yeah.
then as a percentage, it's even though you're getting more income for it, as a percentage of that cost, the sum of fuel is larger as opposed to, say, the R&M, which has stayed the same. Yeah. Yeah. It's a tricky one to get your head around, the old fuel, which is why I sort of.
That's how the FAF works though, is it? I mean, that's how
That's
it's
essentially how it works. Yeah. But yeah, like I say, it was a financier question me. Well, you know, you're getting this extra income to cover your fuel. The ratio should stay the same. But when that prior slide where we sort of change the rates, it doesn't. It alters the percentage of fuel. This is a basic snapshot out of a report that we do for our periodic clients, or even actually this is based on the annual job as well, where we actually run the percentages. And again, if you're not with us as accountants, it's quite good to get your accountant or jump into your Xero and get this to happen, because it's an easy way of looking at your ratio, going 15, yep, that's in that range of ratios we looked at before. Wages, yep, that's 23%, that's in that range of ratio. Really quick guide to sort of see how things are tracking, and it'll quickly highlight if things are blowing out. So, you know, costs of increasing and you're needing to adjust, it'll make it jump out. It's a lot easier to read a percentage rather than trying to sort of look at the numbers sometimes and work out what's going on.
Second half, like that.
Yeah, second half. So we'll carry on with our costings. I'm going to dig into machines a little bit. So I don't know how much exposure you guys have had with machine costings. I find that with our contractors, they probably don't dig into the details too much, but it's surprising how accurate they can be on the rates. They generally often know what the machines are on a day-to-day basis. But if you're digging a bit further into it, there's a whole lot of variables that affect a machine cost. So obviously hours per day, your loader operator, he's probably working 10, 11 hours. Processor might be 8, sometimes it might even be less. Days per year. Now, traditionally we used to cost on 230 days per year, which is effectively basically the available work days in a year. We're starting to drag that down a little bit. your woodlock guys, because they're a bit more variable and moving around a bit more, you know, they're generally, well, historically was sort of 220. But I'm even sort of our more corporate crews, I would cost at 225 now, more.
Why would you do that?
Just weather events and all the other downtime we've had.
But the machine, we've just heard, you know, about machines going more mechanised. So just because a person's away because he's got COVID doesn't mean to say that machine's not working. So shouldn't it really be, you know, related back to the work days that you're expecting those machines?
Well, if the machine's working, that's fine. But I think, you know, with the cyclone and all that stuff that we've had, there's be days where people aren't working, and we've got, you know, we do factor the extra 5 days of sick leave that everyone got, the extra stat days that we've all got. But yeah, there's just seemed a lot more, there isn't the consistency in those work days. Cost, price and resale. So we don't, now this is a figure, we do allow for the trade value in here, which is that resale value there. We don't generally manipulate that figure. Because it's a future figure, you often don't know. And currently, any second-hand gears doesn't have a hell of a lot of value at the moment. It's kind of scary how much that's lost value. Just to give an example, actually, I had a client who wanted a Ford valued. He bought it last year. It had 3,000 hours. Timber Pro. I think he paid $950K for it. He wanted value because he was selling some shares to his foreman. The valuation he got was $650, and there's no way I'm selling it. You know, no way I'd sell my machine, a year-old machine, for $650. The guy who valued it said, "That's a pretty fair price. If that was to go on the market, I'd be lucky to get an offer of $500." A year-old machine. It is scary. Yeah. The other one that factors the machine cost is the usable life, or the hours to be owned. And so here there's a difference between whether it's bashing around in a cutover or whether it's just sitting on a skid and not getting beat up. Also a difference between brands and models. Don't want to stereotype, but you might have your Doosan versus your Tiger Cat or whatever colour is your preference. Everyone has a preference. Track life and replacement costs. So here, I think this is based on a processor. Generally, sort of, yeah, budgeting track life in about 5,000 hours. New track price about 45K. For our felling machines that are swinging off a tether or something, what I understand, they have a different sort of specific track, so they're up around 70K. We're generally budgeting for them. Now, the next really key bit here, that's our fuel price. So here, this is quite low. We've got that at $1.10. Now this percentage here, that's our R&M factor. Now it's kind of a guesstimate over the average life of the machine. It's not based on a new machine, which is going to have low R&M. It's not based on a really, really old machine, and we'll dig into that sort of factoring a little bit later on. But so that's just roughly an average. We do tweak that slightly based on what we know about the machine. Like if we know a bit of the history of the machine, we do play around with that a little bit. Right, so what other factors in there? Yep, interest rates. Now the interest rate figure here, we've got that at 10. That's not necessarily your finance rate. That could be, you might be been in the business for a long time, and that could be just your return on investment rate. So we don't differentiate. It's just the one flat rate that was sort of costing it, and it doesn't. It's possibly more reflective of what is a fair rate of return figure rather than what the actual interest rate is. And we'll talk a bit later on about the difference between the costing versus the cash flow. Insurance, currently budgeting in the forecast, I'd put my insurance at roughly 2.5, maybe up to 3% of my machine values. And then, yeah, the fuel rate. So plug in all those variables in there, and the more detailed you can be, if you're doing this yourself, or if you're coming to your accountant saying, I need a bit of a machine cost for this, the more detail you can give us on these variables, then the more accurate we can give you on your costing, and the more we can highlight, okay, this is what we think, you've probably got a bit of margin tucked in here, you'll get a better result, and especially if you're down the line where you're tendering and price. You have to be competitive on price. The next section I'll differentiate here is, so in these calculations we differentiate between the owning costs and the operating costs. So basically, you don't go to work, you don't have the operating costs, but you're going to be stuck with these owning costs. It's quite good to know if it did happen a little bit where, and I think there's more contracts having it, where they have a stand down clause, because you need to be covering those owning costs in your stand down rates. Right, okay, go to the next one. I was going to call this Mythbusters. This is comparing a new machine versus an old machine versus a really old machine on a costing comparison. Quite interesting, you really think new machine, high debt repayments, it's going to cost a lot more. But what happens is the R&M's a lot less. You can spread the finance over a longer term. The older and you get a high resale based on that sort of resale value from a new machine. An older machine, R&M starts to creep up, starts to eat into that. So you end up, effectively there's not a whole lot of difference in those rates. Per day. Yeah, just quite interesting. It's one that does come up a little bit. Oh, don't worry, I've got an old machine. I can put it in there a lot cheaper. Effectively, it's all about the cost thing.
Just a question versus old and new. You said in the last
Yeah.
slide you would get to it. If you're allowing like a 60% R&M rate from new, once you get through that
Next
first
slide.
warranty period where you have to do what they say,
Yeah.
you're effectively prepaying for when it's old, right? Or pre-billing.
Yeah, again, when we cost, we're talking about the average cost of that machine over its working life.
Yeah.
What you're getting into a little bit is probably more the cash flow. So when we get to the cash flow, that R&M figure that we have in here on our costing is going to be quite different in that first year of ownership in our actual cash flow. So this is the detail in behind those figures that we saw before. And these are the three areas that, if I was, everything that I'd change between a new, an old, and a really old processor. So obviously the price, that drops down over time. But if you're dropping down the time, you're also using it and you're dropping down the workable life. So here's effectively 50%, got 6,000 hours. And then you can see the other thing that goes up is we're increasing that R&M factor. So those are the three variables that are causing those rates to come out pretty similar.
With the lowering of the purchase price, the depreciation will be a lot less. So
Yeah, that factors into there.
Yep.
So it's annual depreciation.
Oh, because you've also done the years of ownership is less. That's right. That's why it's similar.
Yeah. Yeah, so again, just that differential, I guess, between costing for the average life of the machine based on those start parameters
Yeah,
as versus the cash flow.
I've had the R&M a lot higher than 95 on an old machine, but then I haven't actually changed the hours owned or years of life left. Yep, that makes sense.
Yeah, it's quite interesting. And the other thing with the R&M, which is I had to scribble down here, and you often find it with older gear, maybe the woodlock guys, pretty handy on the tools. It's okay because I fix it myself. And yeah, there is an actual cost other than just the actual bill. If you're fixing it yourself, you've got you got the downtime is the biggest one. The downtime where the machine's not working or producing. B, you've got your own time that you could be doing something more productive, running around, getting parts, whatever. So yeah, don't just assume, oh, it's okay, I'll do it myself, I can keep the R&M down. There it's a bit of a false economy. Yeah. What have we got here? Oh, the other point I had here, which was quite interesting. least I did one of these recently where we discussed the options versus, sometimes you get those maintained operating lease versus buying a machine. Now they sound quite good, and when you do the numbers on a cash flow point of view, they do stack up quite well as opposed to buying a new machine. But you do lose a bit of flexibility. They still tie you in for a set period. This one was for 4 years. Whereas if it was for a loader, and if the guy financed the machine over the same 4 years, he was paying, I can't remember the difference. It wasn't a whole lot difference. It might have been extra 30k a year, but then when he finished, the machine would have, sort of based on these sort of calculations, residual value of about 150k, so he was going to be left with something. Plus he had options. He wasn't tied into that lease for 4 years. He could sort of, if things changed, and I know his particular contract was finishes in December, and he's looking for work. But if he got to a period where he needed to go interest only on the finance or something, he can negotiate that. He's got options if he wants to sell the machine. Whereas if he's locked into that lease, he's locked into those monthly payments no matter what, if he's using it or not. So there are those issues to consider, but there are instances where they also stack up, those lease versus buy. And the other one that factors into here a little bit is your operator. If you've got a rough operator and you've chucked him in your $1 million machine, he can turn that into a $500,000 machine pretty quickly, and that's money that you're not going to get back. Whereas if you've put him in your old or your really old machine, yeah, he might knock 100k off it, but it's a lot better than 500k off the new machine. So yeah, sometimes you do consider that as well. Right. Next. Man day rates. So this is one that's really, it's been a rapidly moving target the last few years, and really hard to sort of keep on top of. So the way we work around man day rates, and this is from, again, from just a costing point of view, is we take the gross pays, divide it by the number of days worked, and then average the NTAs to give us this man day rate. And you'll see why that's because when we cost the men into those rate costings, we just average everything. We're not specifying Joe's on this, Tim's on this. We want the averages. But the key number to all this, and this is probably one of the biggest takeaways you need today, is when you get that sort of gross figure, is you need to multiply it by 25.11%. Actually, now that's not quite right. What you do is you take out the NTA, so you take off the 20 off there, so you've got 343. You multiply 343 by 25.11%. Now that's the multiplier to account for all the holidays, all the stat days, ACC, sick pay. As a percentage, if people are quite surprised normally that you need to gross up 25% to cover your wage costs. And if you can sort of follow the maths through here. Everyone gets 20 leave days. There's 12 stat days in a year. This is based on the new one, so we've got Matariki in there. 10 sick days. Now you'll get some good employers that won't take 10 sick days, but there's a hell of a lot that will take every day possible. And then of course, your ACC. So you plug that in, your day rate is that 44984. That's a pretty common standard rate for a lot of people. Possibly haven't got a foreman in there. Often I would cost my foreman separately. So I'd cost a crew on that, and just as a rough guide for a foreman, probably 550 you'd be looking at.
I'm going to ask one of those blonde questions. I'm not sure whether it's just me or people in the room don't know what NTA is.
Non-taxable allowance?
Oh, non-taxable allowances, right, thanks.
Yeah, I've even highlighted the percentage there. That is quite crucial. So what I would do if I was doing a costing or trying to work out my rate, I'd take that man day rate, plug it into there. Some other like the hourly wage number, hourly rate number. You're basically just trying to not fudge the figures, but you're just trying to match back to this, because this this is your absolute, and then number of men. Hours per day is the 9, number of men 7 men. So that gives me my total crew rate of per day of 3,150, and that's the number that I'd bang into my costing. And again, we separate the foreman Just so it doesn't skew the average, when people are looking at screw the numbers. Yeah, so that's that calculation, gross pay divided by the days. So, yeah, I've actually got a little takeaway of some of these sort of notes, what I consider the key points, like the ratios and this multiplier in here, so you can work it out yourself, that fuel price indexing, so I'll give you that at the end as well. You don't have to scribble it down. Right, non-taxable allowances. This is quite interesting, and I mean it's quite a key one for loggers. Back in 2015, IID picked up on the fact that loggers were actively using non-taxables to pay their employees, and maybe we weren't doing it quite in the way that it should have been. So they are hot on it now. It's pretty low-hanging fruit in an audit. Basically, the big thing is, I reckon they realise that there's different roles in a crew, so therefore every person in a crew shouldn't be paid the same non-taxable, effectively. So you need to break up your non-taxables based on the roles in a crew. Don't just go, yeah, 30 bucks a day or 35 bucks for a chainsaw, because they've all got chainsaws when we've only costed one in a crew. So talking about the chainsaws, this is just a rough guideline. You can use any number you want as long as you can justify why you've used that number. So, and to justify it, it needs to be, you need to be able to basically argue that you would have incurred the cost otherwise. So for our loggers, someone that was actively cross-cutting or using a chainsaw, don't really have skiddies anymore, then you can justify that $30 to $35. If you have a clause in your contract, employment agreement, that says must have a chainsaw available, then you can pay them that 10 to 15. But they need to have that clause in their contract. Meal allowance, to be able to pay them a meal allowance, again, they have to have set hours in their contract of 8 hours a day. To then pay the meal allowance, which we've got at 15, they have to work 2 hours overtime before you can justifiably pay them that $15 meal allowance.
What are you paying meal allowance for?
Well, effectively, if they worked overtime and
If it's over 8 hours?
yeah, well, whatever's stipulated in their contract. So if they've got set hours in their contract and they've worked overtime over that, more than 2 hours, then you can pay them $15.
So more than 2 hours over what their normal time?
Yeah, over what their normal day is.
Why?
I didn't write the rules, I don't know.
Legislation.
Mm.
No, but I'm just wondering, where are they getting this meal from to get that money? Like if they were-
It's a regulation that they should have got a meal for their own days.
Yeah.
It's the money,
Mm.
and a little of them not having a meal with them.
Oh, so it's not because you're saying here's money to have the meal.
No,
I'm like, they're out in bush.
yeah.
$15
Yeah. It's
That's like compensation for going.
kind of, yeah. The PPC is an interesting one because with the health and safety legislation, that kind of put the onus on the employer providing health and safety equipment. So you can't just go and pay a big allowance for that, but you can still. There is stuff that I would argue in the bush that maybe doesn't fall under health and safety that is still quite usable. So yeah, we suggested sort of $2 to $5 for that. And my argument would be things like, it's cold, he's got to buy a polyprop so he doesn't freeze to death. I don't know, things like that. You just, again, you pick your argument, justify it.
I think the labour inspector has given good advice. If it's PPE that they require,
Mm.
then the employer should provide it,
Yeah,
as opposed to through
yeah, but
through an allowance.
yeah, I'd still argue that there is some things that that the employee might want to provide that probably makes their work environment better and usable. Laundry's one.
Might be reimbursed for it then, can't they?
What's that?
They can buy it and apply to be reimbursed for it then, no, can't they?
Yep.
Yes, it's on the effect, the employer's still paying.
Yeah.
I think you're talking about though it's over and above the normal PPE.
Yeah, well, I'm saying under this portion, I consider that over and above the normal.
Yeah.
Yeah, because the normal is effectively.
So the non-taxable allowance is an allowance which can increase the take-home pay of your employee, and these are some of the things that you are able to do to facilitate that.
Yeah, laundry's one. garage and storage for anyone taking a vehicle home or keeping oils or whatever at home, you can pay an allowance for that. Home office, if you've got your foreman who's keeping all the sort of load-out records and cooling in stocks or whatever, you can justifiably pay an allowance for that. Sustenance, just because the loggers, they work in the bush, they're not close to a shop or town, you can sort of justify paying an allowance for that they can take their, whatever the energy drink is out there. Tool allowance is an interesting one, but yeah, definitely from a machine op or whatever, you might be able to pay a tool allowance. You would have to justify again that they supply their own tools. Maybe you've got sick of yours going walkabout, so you can say, yep, write that into the employment agreement that they provide their own tools and will be paid an allowance for that, and they might look after things a little bit better. Doesn't really happen in forestry, but if your employee for some reason did take their own vehicle to work, then of course you can pay mileage. You can choose, that's the current IRD rate, that 95 cents, or you can use AA rates, but often for other reasons, most people can't take a private car into the forests.
What happens after that 14,000? Because it goes down quite significantly after that.
Yeah. So that's basically, it pretty much goes down to the running costs after that. They pretty much soak up the owning costs in that 14,000. And you can pay a phone allowance. And I think nowadays, I reckon that's quite justifiable for a lot of people, because most people, that's their main form of communication. I'm sick, whatever. Yeah. We don't get this at work, but I can hardly start my day if I don't have my phone to put on all the authentications and things you need to log into programs now, let alone. Yeah. The only other thing with non-taxables is, and sometimes we do see this being treated a bit wrong, is they're not paid while the person's on leave. So that over Christmas. It's funny, we've done big reviews before with employees and payrolls where we've reviewed the non-taxables and sort of tried to mitigate the risk while sort of getting what we can non-taxable, and doing that in the context of the overall cost to the employer. And often we can get a better overall cash outcome for the employee on a year-to-year basis, but then come Christmas, they drop off. And the employee goes, my pay's dropped. So sometimes that's the hard sell point. Right, next one is the production trap. Where this is important in rate setting is I find a lot of contractors, in the nicest possible way, they have quite big egos. They look at a block and go, yeah, I can smash that out. I'm going to get 350 tonne out of there easily. And they'll come up with their day rate. And forest manager says, well, what are you going to do? Yeah, 350 tonne. And he divides it into his per tonne rate. When you're negotiating your rates, you need to be glass half empty. You don't want to be glass half full. You want to operate glass half full, but you want to be negotiating glass half empty. You want to be saying to that forest manager, yeah, no, we can do it, no worries. But a bit blind around there, we're going to have to, it's good. Yeah, it's a little bit tricky. And you've got to talk it down a little bit, because it has a massive impact on your production. And you definitely want to be, when you're assessing it, really based at least on average production. You don't want to be thinking, yeah, on a good day I'm going to be doing this. Really, really key. So, and just to highlight it, just a 10 tonne difference per day, that's based on that day rate that we had before, on that 11,600, whatever it was. That's just under $500 a day that you're losing. Multiply that over a year, that's 110K out of your profit that you've lost just by overshooting on your ego. And sometimes that can be a load out, and a load difference a day is massive. You're looking at 300K difference. But like I say, I see this quite often where, too many glass half full people, and they sort of, they talk their rate down too much.
Of course, that can happen the other
Can it?
10 tonne per day difference above what you've negotiated.
Yeah.
It's classified as
Which is,
profit, isn't it?
well, depends. It depends if it swings in roundabouts, I think. Because what we find is if it's under, the price managers don't compensate. There's no swing back and say, oh, sorry, yeah, we both
There's no clawback on the other side.
we both got it wrong. Well, the clawback can be, say, yeah, you're only contracted to do this much.
It is important to be sure about the numbers that you're talking about. I
Mm.
agree with that.
Now, the current environment, it is pretty tricky costing-wise. There's a lot of people looking for work, and yeah, the costs have escalated. Everyone's just like, oh, the market don't want to pay that. But then there's a lot more layers of compliance cost coming in. So when you're costing, you really need to know those margins. You need to know where you can and can't trim. Quite important. Don't just rely on the form numbers from 2 years ago. It won't work. Where you can, understand whether it's a long or short term. There are instances where somebody might come to us and say, yeah, I've got this little block. It plugs a gap, short term, and you can, from a short term point of view, you can really suck up some of those costs and go, okay, we can break even on this, or we can soak it up just to keep the crew together, and keep available for future opportunities. So in a short term situation, you can really take a haircut, but if it's longer term, you'll only just be going broke slowly. Understand the big picture, a little bit of what I said before, but also understand the big picture is you might be able to soak up some or share costs. So some of our contractors that have different crews, a number of crews, they might be able to cut back on the admin, on what would sort of be the expected costed admin side of it, because there's another crew sort of contributing to that factor as well, contributing to the covering the accountant's costs. So the more you can stand back and understand that, okay, yeah, I can make some savings there, understand that bigger picture, that's quite good. Now this was something that was pointed out to me a little while ago, and I kind of liked it because it made a little bit of sense, because you do see some people that will slave away thinking, no, it's going to come right, while digging a bigger hole. And what this person said to me was the best way to go broke is to just go fishing. Why slave your guts out at work if your rates are wrong, you're going backwards? You might as well just quit and go fishing. Right, cost versus cash flow. Pretty quick through here, I think. Yeah. Based on those costings that we looked at earlier, you would sort of multiply that by 230 work days. You would suggest a profit of around 131,000. Take off the tax, 28. Suggest that your cash at the bank, at the end of the year, you should have added another 87,000. So the reason I wanted to sort of highlight the difference here is this is the same crew. I've made up the numbers, but roughly what I would put in if it was a day one cash flow. So that income figure, that will tie directly to our costed figure that we had before. But what changes is these actual numbers of the machines, and this is the R&M. Pick on a machine. Oh, rope stever. Yeah. They will be different. I thought I spelt one. I thought I had a one that I had as a new machine with really low R&M, but effectively, that's more what I would expect on an actual R&M on a machine that's sort of 1 or 2 years old. So we've got the hauler there, processor, just going down, and that they will be slightly under those R&M figures on that costing. Is it what I had there? Okay. A bit more on the. This is only. I'm keeping this section pretty brief, but this is again another forecast. Often you'll be asked. Most people will only do forecasts to keep the bank happy. I don't know how many people are forecasting just to actually plan and use it as a planning tool, but it is it is quite a handy planning tool, especially coming into Christmas. Because as you can see here, they've got these overdraft periods. So I'd suggest if you've had to do a cash flow forecast to get finance, just dig it out occasionally and have a look at it and maybe update it slightly, because it does allow you to plan for these cash flow sort of shortfalls. Banks like it a lot more if you're up front with them saying, yeah, coming into December, got holiday pays and it's been pretty wet. They're a lot more sort of open if you can pre-plan that and talk about it rather than go and ring them up going, oh, I can't pay wages, can you help me? So it does highlight that, and also it gives you more chance to assess options. Maybe you can pull back on different costs, whatever. And does allow for a bit of tax planning, and if you, especially if we see it a lot where someone might have started a second crew, so tax-wise, if they've done a forecast, they'll know, yeah, I need to plan for more tax based on the additional income this other crew is going to give me. Right, we're going to talk about ACC, another big cost for loggers. Talk about experience rating, cover plus extra, and payment options. Now this is one that I'm pretty hot on lately, mostly because the client managed to get a $60K refund based on challenging the experience rating for the ACC. So just to quickly, the experience rating applies for anyone that has ACC levies of over 10K for 3 years in a row. It does group companies together, so if you've got multiple companies and they're all linked and all doing logging, they group together for ACC. So one might have a good record, one might have a bad, who cares? You're all counted on the same rate. Now the loading here can range from a 50% discount off your levies to 100% loading. So it has for a lot of our loggers, the ACC is a massive bill. That's a lot of change. And the way they work it is based on your work-related claims in a year, and they weight it 100% on the first year, drops down to 70 on the second year, and then to 40 in that year 3. So here we have an invoice from ACC. Now ACC invoices now are about 3 or 4 pages long. They take a little bit to chew through and work through. But this is highlight bit, here's your experience rated bit. So I don't know if you can read from there, but that's got a load in of 30 in that year, and the wash up from the prior year is loaded at 10. So in this case, we've got an extra cost of 11,450 there, extra 3,957 there, total cost of extra 15 grand just on that experience rating. And in a worst case scenario, at 100% loading, it could have been an extra 77,000 on our invoice, or they could have saved 38,000 if they'd had a 50% discount. Which it's a 116K swing. It's a massive variance, and I don't think people check their ACC and police it enough. Because what was highlighted is you need to check: is it actually a workplace accident? When someone goes to the doctor or whatever, fills in a form, there'll be a box: was it work related? And most people think, oh yeah, if I tick that, I'll get that first week's pay rather than stand down. They tick work related. Not thinking that that's going to impact their employer. So it is worth checking if you get a notice come through, your employee's had an accident, dig down, is it a work-related claim, and manage that. Because in this case here, or in the case that we came across, they worked out that no, it wasn't. It was definitely a household incident, and that changed the rating.
We had one where we actually got one for, your worker's been injured. It wasn't even someone that worked for us, never worked for us. And I was like, I managed to get rid of it, but I was like,
Yeah. Yeah, so when it comes to managing, you can get a My ACC login, just like you can My IR. Go in there, follow through the timeline down to account activity, and then that'll list your calculations. So this is your claims. This shows workplace-related claim here. Now this doesn't relate to the one that I had, but this was interesting. This is another client. And when I read this, I was like, head injury with neck pain. I'm like, okay, mostly machine ops. I look at this and I don't think that's probably a work-related accident to my mind. I haven't had the conversation with this client, but that could easily be a rugby accident, could be a motorbike accident. Yeah. Yeah, I've actually got a sneaky suspicion this one might have mentioned that one of his dudes did have a mountain motorbike accident, and it, like I say, it ties to that. But anyway, so long story short out of this is, yeah, like I say, we had a client that picked up on that rating going to 30, and for them they had a group of companies, and their ACC bill jumped massively, and they dug into this. You can drill down on via that My ACC to this sort of report. It'll tell you who your employee is. It'll tell you the details of their accident, and you can query it. You can just dig around. You can always ask for a doctor's certificate or figure it out. And they queried it and got 60k refund back from ACC by getting that experience rating.
How do they work out your experience rating based on that? Like, what?
Oh, so that was those loadings before, based on those.
How do they work on 30%, 40%? Like, where do they get that amount from?
How many incidents?
Oh, I don't know. Yeah.
How many incidents and how many days off work per incident?
Yeah.
That's how they work it all out. That's, you gotta jump through mega hoops to get
And
it
then
sorted.
yeah, and then they judged against your industry average as well,
Yeah,
against
so
everybody
you've already
else.
got a, I think it's 15 or 20% loading involved in it already. So you can't go
Mm.
further than that anyway.
If you're electronically checking it every week, there'll be times where you find out about an injury that's registered anywhere between a week and 2 weeks ahead of getting the paperwork sent through to you by ACC. So you're that much closer to the event. And those of you that are employing and managing these will know that it's worse than an employee thinking the boss pays the first 5 days if I tick its workplace. GPs are encouraging people to think and tick workplace. It's quite a reward.
We are running
Stay on top of it.
quite short on time. We're not too far off. Cover Plus Extra. Do people know about Cover Plus Extra? So Cover Plus Extra is an ACC product as well, where it allows self-employed and non-PAY shareholders to agree to a fixed level of ACC cover. Where it's really beneficial is, think of it as an income protection insurance. That's effectively all it is. But where it's quite handy is if you've had a bad year, you're not going to maybe get declared as much shareholder salary as normal. You can agree to a fixed level of cover. There's no questions asked. It's also quite handy if often you see a husband and wife. Under Cover Plus Extra, they can split their levy rates. So, don't want to stereotype, but if the wife's home doing the admin, she can be on an admin rate, whereas the husband can be on the higher forestry rate. Whereas if you just pay them a shareholder salary out of the company, they're both on forestry. So that is quite handy, and that can.
About like other people, because that really this is a bit of a bugs a little bit with this. So yeah, I'm on an admin rate. What about other people in the business who are admin who aren't on site and they're going to be paying a logging rate? I mean,
Yeah, it is tough. They're pretty much stuck on the highest rated activity of that company. So split it out maybe. You can split out the, I know we have clients that'll split out the admin function and charge a management fee to the company. So the admin function is a separate entity, whether it's,
like a separate business.
yeah, separate business.
Yeah, we have to. Yeah, because it is.
Ways to pay, ACC, very brief. Yeah, they will let you do instalments as well, generally 3, 6 and 10 months. They generally charge, they call it an admin fee, but it's pretty much an interest fee if you're paying it over 10 months. But after the cyclones, and with a bit of sort of lobbying from the women in forestry, they're currently, if you ring up and, I don't know if you have to ring up and let them know or not, but they are writing off that interest component if you want to pay off for forestry currently over 10 months. But yeah, normally there is an admin fee. I'll quickly rip through my odds and sods. This is just the random bits that I think are a bit helpful. Christmas shutdowns. You must give your employees 14 days notice if you're requiring them to use annual leave and shut down. You can only do one shutdown every 12 months unless otherwise agreed with your employees. New employees are paid 8% of the gross since they started, and that can be paid in advance. If it's a new employee started during that year and you're having an annual shutdown and you pay them that 8% of gross, their leave anniversary actually then moves to the shutdown dates, start of the shutdown for the future year. So when they get to the next Christmas, they've got a full 4 weeks. Cashing up holiday pays. This is another good one for the loggers. A lot of the guys like to cash up a lot of their leave. Legally, you can only do 1 week maximum in any 12 month period. And you don't have to agree to the request or give a reason why you don't agree. You see all sorts of workarounds around that, but effectively that is the rule. I chuck this in here just for more sort of a, I guess, refresher. Sources of finance, yeah, it can be yourself, your family, bank, finance companies, creditors. You can use IRD and delay payment there. Like I say, they will charge the interest and penalties. And just beware the hidden costs of borrowing. You know, sometimes, well, traditionally, or you pick on banks. Banks can be, you know, if you have a lot of equity and meet all their strict criteria, they can be quite a good lender. You can generally get quite competitive interest rates, but they can also impose a lot of additional costs. So they might have a lot of covenants in there about, we have a lot with quarterly reporting, so you have to pay your accountant more every 3 months so we can just keep the bank happy and that sort of side of it. They might want more guarantees and that might clock up more legal fees. So yeah, just be aware of those hidden costs when you're looking at different funding sources. This is an old graph that I pulled out from, it was like 2003 or something. But it just, again, it was a conversation I had recently with someone. They were talking to a lender, and the lender was like, don't worry, we can drop those repayments down. We'll just push out the term. And this graph just highlights, well, my key thing here is just whatever financing you're doing, like any debt, the sooner you can pay it off, the better. But at least match it to the life of your machine. Don't have it go beyond that. Because what you can see here is asset value drops, the loan's been spread out, and now the loan's more worth than the asset, and you just eroded all your equity. It does happen occasionally, and it's purely to finance salesmen, I call them, basically. And they think they're doing you a favour by helping your cash flow. Finally, finish with the plug. Yeah. So we are Blackburn Group. We, like I say, we're fairly specialised in forestry. We actually do quite a lot of consulting work. Well, we do the normal accounting stuff, but we actually have clients that aren't with us for their normal day-to-day stuff, but will use us for the forestry specific stuff, whether it's costing and or finance.